Thank you, everyone. Obviously, didn't expect this turnout, although we're pumped for it. We'll reevaluate in future months, but we'll continue to have this on the second Tuesday of every month. Those of you who don't know me, I know most of the faces in the room. My name's Darson Grantham. I'm pretty involved in the real estate investing world. I am an agent for Keller Williams, but I basically do this stuff because when I started investing, I started having coffee and lunch with every single investor that owned property in Des Moines that would have lunch with me, and so or coffee. And so the networking is a huge portion of just what I've accomplished, if you will. And so I love this stuff, and that's why we're all here. So obviously these guys have a ton of knowledge, and we're going to get into that. When you guys are talking to people around you, go grab cards, go grab coffee, sit down with them. You never know what story they're going to come get out of you, or you're going to get out of them to learn something. So I'd highly, highly encourage that. So the agenda we're going to go through is just a national data trend type thing, and then a local trend where the real estate numbers are at. If you have any specific trending questions that you want that I didn't talk through, just shoot us an email. We'll try to find it. There is a way to spin any kind of trend, any kind of data. I will be the first to admit that you can spin anything really good or really bad. So, but if there is anything you want, let me know. I'll do my best to look it up. Let me make sure I'm getting all this stuff. So next month, probably not going to be here. Don't tell them that. As long as this goes well, it's probably not going to be here. We're going to have Brad Neal with Renters Warehouse give us a trend report on rentals, where things are standing, vacancy rate. I mean, anything that you could think of is with rentals. These guys that have a good idea of it too. Brad obviously runs Renters Warehouse, so I wanted to have him on to share his opinion and everything. That is all we have lined up so far. So we're going to go local trends. So I just pulled these from the DMAR Housing and Trends Report. August of 2022 versus August 2022, there's 1,470 sold properties. That's up from July of 2022, which is surprising, but it's down from August of 2021. So big headlines are number of solds is down, I think it's 13 or 14%, pretty big number. The median sales price from July of 2022 was at 272. So a year ago it was 272, or excuse me, a month ago it was 272. It's down to, in August, to 268. It's up, let's see here, 5% from a year-over-year standpoint. So August of 2021, we're up 5%. So if you think about that, median sale price, I've argued whether you should use median or average. We're just going to use median because that's what everyone else uses. It is up 5%. So the world is not crashing. The world is not, crazy things aren't happening. But there is movement in the market, and I'm sure these guys will talk about that a little bit. Days on market was actually higher in 2021 of August. So August of 2021, a year ago, days on market was 29 days, and August of 2022 was 24 days. That was a stat that stood out to me that I was like, I wouldn't have guessed that the days on market a year ago would be higher than it is today. What that means, obviously properties are selling a little bit faster. If you can pinpoint that to one thing, I have no idea. If any of these guys know, I don't know that answer. What? Watch till the end. That's a hook. That's the hook. Okay, let's see here. I think I hit everything on just local market stuff. National stuff. I listen to a lot of content, right? And so Bigger Pockets on the Market, I believe it is, was basically a trend data driven podcast and YouTube show. And they talked about, it was 2 or 3 days ago, they talked about why 2008 was different than 2022. And a couple things they pointed out that I just wanted to bring up of things that I didn't think about was in 2008, mortgages that were accepted that had a credit score of under 620 was 14% of mortgages. So they had a credit score of under 620. In 2022, that's only 2%. So you have, like, that is a data point of people that maybe couldn't have afforded mortgages that were getting them and resulted in a domino effect. Other thing that I want to point out, and then we'll talk to the panelists, inventory. And this is national, so again, national numbers. Inventory in 2008, it was 3.7 million homes. At the beginning of 2022, it was 860,000 homes. And it's doubled, or almost doubled, to 1.3 million to date. So the inventory, properties that are coming onto the market, we are still a third of where we were at in 2008. So obviously we can't give a crystal ball of what is in the future, but we can watch these stats, we can continue to watch them so that we know and can see changes that are happening, and we'll just continue to watch them throughout ever, quite frankly. I don't, and I'll ask you guys this at some point, when in 2008, did you watch trends? Did you watch those numbers change and all that good stuff? But we'll get into that here. One thing I didn't mention is Ryan will so Ryan's the one that told me to start this event. He's like, hey, we need to do it along with a lot of you. And so he's sitting up here because him and I have kind of co-hosted. I've kind of ran with it because that's what I kind of just do. But yes, I wanted to point out Ryan's over here. And he runs Home Life Brothers construction company. So anyway, anything else to add? You good? It's questionable. Okay, so panelists, we're going to ask them each kind of their history, and then we're going to have specific questions for each of them, and then we'll end with the economics of 2008 versus 2022. And so everyone, we'll start with Bob. So give Bob the old mic. And
all right.
Bob, how did you get started in real estate? What did it look like starting for the first 2 years, and where are you at, or what are you doing currently?
Okay. So I started a long time ago. My first purchase was in 1986. Back then, interest rates were 13% for a rental property. And I got interested just because where I was working, I basically got promoted 4 times in 5 years and realized I wasn't going anywhere else. And I was 24 at the time. So when you realize at 24 you've hit the top of where you're at in your market, you start looking for other things to do. And so it took me a couple years. Looked around, got some books about different things, landed on real estate. I felt it was the most flexible vehicle for people. You could do just about any aspect of it, and it will meet your personality no matter what it is. So you can find things that'll work for you, whether you're a racehorse or you're a plow horse or whatever you are.
Where are you at currently?
So where I'm at currently, so I'm mostly in small towns at this point, and I started in Ankeny, did a lot in Des Moines and some other places. I'll be completely out of Des Moines by the end of this year, and I like the small towns. It's a little easier to work with the inspectors, if there are any. And I have single family homes. I have apartments. Cool. And what else?
Yeah, that's good.
It?
Yeah.
Okay.
We'll pass it on to Owen.
Hear me okay? Okay. My name's Owen Dashner. I live in the Omaha, Nebraska market, and I got into real estate investing in 2005. Started buying, I had no money. I had a full-time job, hated my job, tried to figure out a way to get out of it. 20 years later, I finally got out of it, and I did that by flipping a house, buying a rental, flipping a house, buying a rental, rinse and repeat, pretty much all the way through the financial crisis. Bought a lot of foreclosures, REOs when I first started, transitioned eventually into kind of a direct-to-seller marketing type business. So my business partner with my cash home buying business is Brandon. He's over here too. We buy about 30 to 40 houses a year. About 2 years ago, formed a hard money lending business with Brandon and a couple other partners called Liquid Lending Solutions. We've done about 210 loans in about not quite 2 years. In Des Moines, Omaha, kind of the surrounding area, and we've done a few in like Michigan, Illinois, and we're kind of branching out into some other states. Own a small piece of a title company just for the transactions we were doing, and have roughly about 155 rental units, mostly apartments, some single-family houses. Yeah, so that's me.
Cool.
Chase Gochnauer. So I'm 37, and right out of high school, I decided I wanted to get into the real estate world. My dad was one of those that spent money with a lot of gurus and stuff when I was in the high school years, so I learned a lot that way. He never pulled the trigger on anything, but it kind of gave me a nice foundation. Again, didn't have any money starting out, so I went into I got my real estate license, started selling houses, started selling REOs, so I was an REO agent for a couple of years until 08. Everything went a little crazy, so I got out of the agent world for a couple of years and started a business maintaining foreclosed houses. So I've had that for about 12 years now. So we do 13, 14 states, have some employees here in town doing that. And then from about 2013 till now, started acquiring properties here locally. Have 300 doors now, and half single family, half apartment and duplexes.
All right. I'm Dave Ferris.
Woo, Dave, let's go.
Thanks. My wife and I started buying properties in 2004. So we, read Rich Dad, Poor Dad, like a lot of people do. Went to a seminar beforehand, figured that might be a good thing to do, is to buy properties. It probably took us about 6 months of looking before we found our first couple. Then we did buy them. Realized that was pretty easy. It went well, so we bought I think 7 more the next year, and 4 or 5 more the next year. So in a few years, we acquired about 15 or so. We bought an 8-plex after that. That was in 2008, or a 10-plex it was actually, and I managed that for a few years, long enough to know that I wasn't good at managing apartment buildings. So we sold that and just kind of bought some more on contract and did a number of different things throughout the years. So the business my wife and I started, we have about 25 single-family houses now. A year ago, I started a investment business with Junior Barra and Ryan Cahoy, and so we have IRG Instant Offers. Over the last year, it's been about a year. By the end of the year, we'll probably do about 24 deals. We'll keep half of those, and we will have sold about half of those. Some contracts, some wholesaling, some flips.
Cool.
Yep.
Awesome. Okay, so now we have just individual questions for each of you. So Dave, just hold on to that. And it's gonna be one question, so each of you chirp in if you have anything to add or anything that stands out, but we'll just start one question per person. Dave, how would someone get started in today's real estate world?
Okay. I'll try to keep it as easy as I know how to do. So I would say there's 3 main things. The first thing is education. Read the books, attend the network events, meet the people. I mean, you got to do that. You got to learn about the industry. Secondly, you got to figure out what your buy box is. So are you looking for multifamily or are you looking for single family? Once you figure that out, then realize how much appetite you have for rehab. Do you want to do a lot of renovation? Do you want move-in ready? Some paint and carpet? What's that level going to be? Once you figure those things out, then you at least know what you're looking for. The third thing to do is to find your financing. So figure out, are you buying cash? If you have enough cash for that, do you got enough for a down payment? Are you using a home equity line of credit? Look for a bank. One way or another, line up your financing, and then you can start looking for your properties.
Cool.
The other thing I'd add is house hacking. That's something that people talk about a lot. But until I basically got married at 25, I don't think I ever lived on my own. I always owned a house and rented out 1 or 2 rooms to buddies or whomever. They help kind of build up that cash to be able to do projects and buy properties.
Yeah, that's a great way to get started.
Yeah, I'd add one thing, and that is once you're doing your education and all that, once you land on something, focus solely on that. If it's single family homes and you're flipping or you're holding, whatever your strategy is, focus just on that. And I think you'll be surprised what comes into your view when you do that. If you're looking at everything, you end up seeing nothing.
I actually love that. I would echo everything these guys just said, and I would also add on, I make in my business one like KPI or key performance indicator is how many new people am I meeting with, and I have a goal. I want to meet with one person in the real estate space, investing specifically, that I have never had lunch with or coffee with or had one-on-one time with before, every single week. And at the end of the year, when I'm kind of keeping score on who I've met with, I figured out after a while of being in the recruiting and HR business over the years and interviewing thousands of people that the only limitation you really have is the quality and quantity of your circle. So the more people you can include and be genuine and go into it with, really just, you have no agenda. You just want to meet good people, get to know them, and make friends. And the more people that you surround yourself with like this, going to meetups and lunches and kind of small one-on-ones or small group settings, you're unlimited in the stuff that you can do if you have the drive and attention to keep the motor going. You got to pay attention to your family and friends and job and all those things, right? But if you don't make that part of your business, you're going to be coming back here in about 3 years and you're going to be in the same spot. So I think making those things that you can click off and say, you know what, I had lunch, and you measure the funnel by what goes in, not what comes out. So focus on the things you can control, like your inputs, your leading indicators, not your lagging indicators. And I think you'll be in a much, much different position, even 6 months from now.
Cool. Keep holding. Go ahead. Yep. Hold on to that. So next question, how much does someone's network play into their real estate success? So you just answered that.
I always skip ahead on
there
tests.
you go.
Yeah.
If you have more, or you can pass around. Or
Yeah, I would just give examples, and I don't feel like I do anything special, but I seem to be around a lot of people that are doing things that are moving the needle in a lot of different things. Like I got asked, I'm a co-host on a humble brag here. I'm a co-host on a podcast. It's called RIA Radio. Ted Kosh, my partner in crime with that, badgered me for a while to get me to agree to come on it, and I talk nonstop as we have a 45-minute limit here, right? So, but we got on that, and that's a lot of fun. I met a lot of cool, kick-ass people just being a part of the podcast, but that opportunity came to me only because I spent one-on-one time with Ted and with other people that go to these meetups. And just, it can be overwhelming, especially if you're in a room like this where it's so crowded and you don't really have a lot of quality time, and most people are like, okay, well, that was fun, I'll see you next month. But don't do that. Stay a little while after, get some one-on-one time, approach somebody, find out who they are, just find out some key things about them that you can take away and apply to the next time you run into them. And I think that those things are yeah, okay, that's not really, what about multifamily and what's cap rate and all that? I think if you focus on the people, not the, numbers and everything else, I think you're going to be really surprised at the end result of all this. So.
Yeah.
I'll add something to it. Just as a quick example, I think I met Junior Ibarra probably 12 years ago. Is that what we decided? 10 years ago? Something like that. It wasn't until last year that we actually decided to be business partners. So you just don't know. Just keep in contact with those people, because you just never know when that's going to come to fruition and be an excellent decision. Who's next?
Yeah, I'll say something. So to go the other way, for all you lone wolves out there, I know there's some out there. I was that way for a long time. I didn't have any partners, and just whatever I could do, I did. I learned everything. You learn how to buy, you learn how to finance, you learn how to manage, you learn how you learn how to convert a property from one use to another. And you do that on the fly, but it's a slow process when you do it by yourself. Once you start networking with other folks, partnering with them, you got to get the trust level up. That's one of the issues, right? So if you can't trust someone you're working with, it doesn't matter what you do. It's going to fail. So, but your results will accelerate if you work with other people. May not at first, because now you're not getting 100% of the deal, you're getting 50% or 25%, right? But then once you start expanding, you start doing bigger deals, and you're getting a bigger percentage. Mm-hmm. So, and it comes. You just got to keep at it.
Cool. Good.
Hot potato.
Yeah.
All right.
Bob, this is working out perfectly. You're up.
It's like we planned it.
Someone did. When Partnering, working with a beginning investor, what do you need to see out of them? Have you, I guess.
Okay.
And then what do you need to see?
There's a few things. One thing is I like to see curiosity and initiative. So if someone is willing to learn and can go out and find answers to problems, that helps in a partnership, especially if you're both that way. But if you have someone that's kind of deadheading you, where they're only taking what you say and only doing what you say, then they're not a partner, they're an employee. And so you got to switch to that mode. And I've had that happen a couple times. And you switch to employee mode, you tell them what to do and they do it, right? And that's it. But on the partners, you're both contributing, or more, if there's 4 or 5 or whatever it is. So other qualities, follow through. I can probably think of another one. But
Yeah.
I would echo all of that, and I would also say that I'm looking for hustle. I want somebody that is like, they have the balls to go and grab a meeting with somebody that's been in this business for a long time, and they're going to go out and, you know, knock down walls if you tell them you're expecting that. Somebody that takes the time and puts in the work to learn the education that gives them a solid foundation in this business. If they're not willing to do that and they want you to, like you said, I mean, it's like mama bird feeding baby bird everything, and they're relying completely on you for all their information. No thanks. I mean, you know, we're all busy, right? And we want to be around people that are hungry. And like, I think, and I don't know, I think most people in here would probably agree with me in that people want to see, if it's a young, you know, wannabe investor, they want to see some attributes that they had when they were younger. So somebody that experienced some success and has been through a lot of the trials and tribulations. I mean, let's face it, you get kicked in the balls and face many times in this business. But if you stick with it a long time, you learn a lot of stuff along the way. But you have to be willing to go through those tough times in order to be able to persevere and pass along your knowledge. So I want somebody that's willing to do those things and mess up and maybe give them enough rope to hang themselves. I'm throwing a lot of parables around here, but I think, yeah, it's like I want somebody that shows me they're willing to go out. If I say, hey, they're like, hey, how can I learn? And I say, go read this book, listen to this podcast. And they come back and they say, I did all those. What next? I'll be like, all right, now we got something. And then you can start giving them, tasks that maybe don't move the needle for you necessarily, but they're things that are either annoying or you don't want to do, or things that are going to help them learn, but also get them off your plate. And then eventually you can start giving them heavier lifts, right? So I think that hustle will outpace a lot of, there's the saying, outkick your coverage. A lot of guys have heard that, like me, with their wives. But I think do those things, and I think you'll go a long way with somebody that's an experienced investor.
So I've actually never went down the partnership path. So when I was an agent back in 04, 05, I had a partnership in that world that didn't work out the way I had hoped, I would say. And so ever since that, I kind of, to the lone wolf talk, I put my head down and just put in the work. So partnerships have not been a thing for me. So
not legally, right? But you have developed relationships, right?
Yes,
so that's the difference,
absolutely.
right?
Well, and that, most of the deals I found have been from, when you find, especially when you get into the bigger deals, right? And most of it's not on the market. So it's all just somebody somebody you had lunch with that calls you up and says, hey, Chase, there's 125 houses for sale. Would you be interested? Yep, I would. And, you have all that information before it even hits the market.
Sorry,
Yeah,
I didn't mean to interrupt.
Go ahead.
I would say one thing, if you're looking for, it's one thing to partner on a deal, but if you're looking for a business partner where you're really partnering on a business long term, I would say also look for people that have other skill sets different than yourself. So if you have everything in common and you have the same skills, the same talents, you're not really benefiting. I mean, you're getting along great, but you really need those people that have other skill sets than you do. So look for that as well.
Yep.
probably one last thing
Yeah.
is make sure the goals match up. So whether you're doing one deal or you're doing a business, make sure you understand what motivates them, what's their dreams, what's their aspirations, what do they want to get out of the partnership, what do they want to get out of the deal, whatever it is, match it up with yours and see if there's any issues. If it's pretty much in line, then you got something. But if you're going like this, it's not going to work.
Love that.
Cool. Okay, Chase. Last one. Well, kind of. Last individual. How does someone decide what real estate specialty they should be in?
So my preferred choice was just to dabble. Like I said, I was an agent for a while. I got into the foreclosure maintenance, which is more the construction side. I found a commercial property, small commercial property, bought that, kind of flipped that, decided that really wasn't up my alley. I did some apartments, and I enjoy the apartments, but then the single families was just where my passion is, I would say, and so that's kind of where I stuck. But I just say get involved in the different areas. If you know some people where you can get involved into a flip and see it, even if you're swinging the hammer, at least you're involved in the process and can learn. That would be my recommendation.
Anything to add, you guys? Good? Sweet.
Go ahead.
Go, Bob.
It's not.
Not
The thought's
top
not forming completely.
Cool. Okay, so now we'll get into the economics of 2008 versus 2022. So we'll just start with you, Bob, if you're okay with it.
Yeah,
we'll just go down the line. What parts of today's market, real estate market, feel the same as 2008? And then we'll follow back up with what feels different.
Okay.
So what's the same?
To me, very little. The fear, what's being projected out there from the media and YouTube pundits and all this. The way they sell everything is, you got to do it today. There's disaster and calamity everywhere, right? So
It felt that way in 2008 also?
the fear.
The fear did?
Fear was projected in 2008, just like now. I mean, as you saw, you heard the numbers, right? Does it match up with what you're hearing in the media? Nah,
Agreed.
not at all.
Yeah, just pass it down. And
I remember I was just kind of getting some traction in 2008, and I had 4 flips going at one time, and a full-time job and a newborn, and was really struggling, just like trying to get my arms around all of it. And I remember I had a mortgage with Bank of America on a rental that I had bought, and Bank of America, that didn't go well for them. And I was like, does this mean I don't have to pay back my mortgage? Like, there was so much unknown out there in general that people are like, what is going on? You mentioned kind of like the not uncertainty isn't what you said, but it feels a little bit like that. Maybe like the first, glimpses of uncertainty are kind of similar to how 2008 was. But back then it was like, oh my God, like Bear Stearns went under, Lehman Brothers, like all these banks were failing. And then it was just, the stock market was just cratering every day. And I'm like, hope I can sell these houses. And around that time, like the first time the home buyer tax credit expired, you used to get like $8,000 if you were buying a house. And that went away. And I was like, this is maybe not the right time to be in this business. But I would say uncertainty at the time. And it feels like sellers are really slow to grab onto the reality of the current market conditions. Because I don't know if you guys are seeing this in Des Moines, but I know in Omaha, there's more time on market. There's more people that are holding on to a sale price that they could have probably gotten about 8 months ago. And now they're resisting what buyers are telling them, or the market is telling them, and that it's not worth that anymore because interest rates are climbing to a level where people can't afford as much house. So even starter homes that used to sell like hotcakes in good areas are like sitting a little bit longer. You're starting to see, when you're selling a home, more inspection addendums coming in where you're required to repair stuff instead of just selling it for cash to whoever. And so I think I don't know that we're in the same boat as 2008. I hope not. There were a lot of opportunities that were created out of that, but I think the uncertainty scared the hell out of a lot of people. And people didn't really know how to react to it. It feels similar to that right now. It's like everybody's in stasis and waiting to see what the next move is before they get aggressive on things.
It's hard to follow you, Owen. But no, I would echo the others on just more the doom and gloom. You know, that's the thing that's the same. It's just the doom and gloom. And you know, and you say '08, but it is kind of like a slow-moving train wreck. You know, so it's not just one day in '08 it all went bad. It's over a period of time. So you know, it's to be determined on what that's going to look like over the next year or two.
Mm-hmm. Yeah, I'm kind of the same with these guys too. It's the inventory numbers are creeping up a little bit, but. I mean, the economy is completely different. The market seems, you know, it's clear that we don't have enough housing for the people looking. You know, that seems. I mean, rentals are the same way too. There's not enough rental houses for people looking. So
yeah,
a lot of
I was going to say.
Oh, sorry.
Yeah, no, that's fine. We'll go what's. Yeah,
Okay.
that's perfect. So now what's different?
What's different?
'08 to now.
Okay.
Yeah.
You know, one thing I wanted to point out, which is maybe a little bit different, but I went back and I looked, and you know, when we started buying houses through 2004 and 5, the interest rates were at 5-6%. We were the investment rate, you know, so we were buying rental properties at 7% interest. It wasn't until 2009 that it actually dropped below 5, and so all that it was actually the interest rates dropped after, you know, as a result of 2008, and so. You know, people are freaking out because interest rates are back up above 5, but you know, it's just kind of the way it is. So I guess I just wanted to point that out. But
Well, I think to add to that, one thing I heard, or I've heard, I don't know where I heard it, but it's basically if the rates go down again, it means the economy tanked. Right? Like that's
True.
just that's what caused them to go down. So if you mind shift that of like, okay, that means the economy really something happened, whether it's in your industry, or it's someone else's industry, the market went. The economy went down.
The rates always lag.
So, sorry.
I'll just go ahead and pass.
Yeah, so to me, one of the biggest differences is the way is financing. So, you know, back in pre-08, I mean, anybody could get a loan. As an agent, I remember a waiter that was making like $4 an hour, but, you know, on paper, and he was cash tips, but he was able to get, you know, write down 60 grand as a stated income and get the loan still. And stuff like that you just don't see as much today. And there was a lot of, I would say, shadiness going on in the way down payments would work too. I mean, there were actually companies in town that would help finance a down payment at closing for the seller to give it right back to the buyer the next day. So it was essentially 100% financing that the bank didn't even realize. And it became so common, you know, if you were to hear that now, it would kind of sound shady. And then it was just so commonplace, it didn't seem shady almost. You know, so the banks were stuck and owners in a position with basically no equity. So
I thought it was a great idea.
Yeah, I mean, yeah, sounds like a great idea. And, you know, in hindsight, it's like, well, wait a second, that isn't right. You know, so the banks were obviously upside down, and then the people, you know, were at 100% financing, which is a tough place to be if the market drops at all. So didn't take much to hit the first domino.
I think back to 2008, 9, 10, and I remember there were a lot of builders that were just cranking out houses and condos. Do you guys remember like Miami and like Vegas, and they were just churning out these condo projects? And then it's like the music stopped and everybody's like, okay, hang up their hammer, and then like everybody bails. So there were all this glut of unfinished homes in like Phoenix and Vegas and like all the coastal areas, which are kind of the canary in the coal mine for us guys. I mean, I'm sure everybody knows that, but it's like the Midwest, we're fairly insulated around here from extreme market conditions. So it's like you mentioned, I think you mentioned it was like a slow moving train. Yeah. So you can kind of watch it. It's not like we're going to get hammered tomorrow and the housing market's going to tank, 10%. But I remember that, and I look at now, and a lot of builders went under during that time period. So we have a lag in housing inventory that is just never going to catch up unless something drastic changes with. And I don't know if it's technology like 3D printing, or if there's some government programs that come out that really incentivize builders, and we end up subsidizing it as taxpayers. That could happen. We just don't know. But I look at now compared to then, and I say they've tightened up the loan requirements. There's no more liar loans, or if there are, but they're masked. Yeah, it's lipstick. I look at now, and I think that's the biggest difference is there's the lack of inventory, and it's not like it's going to happen and rain houses from the sky in the starter house price point, because nobody can build there. I mean, have you guys seen a new build that's less than $300,000? I assume Des Moines similar to Omaha, right? Like you can't build for that and still make the profit that you need to keep your business. So yeah, I just think it's a weird time, and then we've got spiking interest rates. One thing I'll add on that is, you know, a lot of people freak out and they're like indecision because they don't want to buy anything when it's 6.5% interest. But like you said, we've been there already. It's just you haven't been in the game long enough. But I think it's like you date the rate, you marry the house, right? If you're getting a rental property, it's not like you're locked into 6.5% or 7% forever. You just do it until the rates, you know, go down. And like you said, it may be an economic shift that causes that. It probably is. But take advantage of it, lock in a lower rate when the time presents itself, and then quit complaining. Like just underwrite it better, right? Buy a better deal.
Yeah, it's, in any environment, if you got something that cash flows, you buy it, right? That's all it is. It's that simple. So where it was, I was paying 13% interest and way back when, but they cash flowed at 13% interest. So eventually,
nuts? That's just nuts
Yeah.
to even think about.
yeah. But eventually the rates went down, and you know, by the time they got down to 9 and I refinanced, it cash flowed even more. And then they got down to 7 and I refinanced, and it cash flowed even more. And
Out of curiosity, do you still have any of those?
actually, no. Those are the
Yeah, I'm just curious. The
like
values
about 2 years
from then to
ago.
now.
I held them like 30 some years.
Oh, wow.
Yeah.
Cool.
Well, I traded them. I traded them in for an apartment. So.
Yeah.
Cool. Okay, that's all the questions I had. So we're gonna do Q&A for, I don't know, 5-10 minutes, and then we'll just network. So, anyone have any specific questions that we didn't answer that on the tip of their tongue? I'm gonna sit here until someone. There we go. In the back.
Say something about 3D printing. I was going to get anything to add on.
So.
Question was about
Yep,
3D
yep,
printing
so- yeah.
for houses.
Yeah. So yeah, question was 3D printing for housing. Who knows something about that? What do you know?
I don't know how I ended up with the mic. I just threw out a term. I don't know. I don't know much about it. No, actually, so in Southwest Iowa, I'm from a small town there called Malvern, Iowa, and there's a couple of towns that are participating, and basically a local builder has brought in 3D printing, and I don't know what kind of incentives they have, whether it's government or municipality or both or grants. But they are starting subdivisions of 3D printed housing in Southwest Iowa. And I know that's not the only spot. You guys probably have some around here, maybe. I don't know. But, I mean, pretty cool. I don't know what the cost is compared to like a stick-built house or some, you know, prefab or whatever, you know, more economical. But I know the materials are still hard to source. Like the inputs you still have to get for the printing, you know, the materials that are the inputs, not the outputs. So I don't know what the cost is on that. I'm dying to find out because I've talked about this quite a bit, and for the lack of knowledge I have, I talk about it a lot. But no, good question. I think that may be a way that we are able to fill in the gaps on affordable housing to an extent. Maybe something else comes along in the next 10 years that we don't even know about. Maybe we all just live in the metaverse. I don't know.
Oh, it has to be brought up.
Yeah, I was going to say.
Out in Des Moines,
Yeah.
they is in the 3D printing business. They aren't actually doing it right here, right now. They're actually doing all their testing and stuff down in Tennessee. And he actually said that the materials right now are high on the 3D printed side, but as they are able to start making them themselves, it's going to come down to be very comparable to what it is to do a stick-built house.
Do you know what do they make them out of? What is it?
It's
like a resin or
It's a concrete.
concrete something?
Well, it's kind of like the creation of like technology in general. It starts really expensive, and as time goes on, it gets lower. Like, so that makes a lot of sense.
That I got out of that was, like you said, they're going to do the 3D printed developments, you know, the housing developments and stuff. The printer will actually go on rails where they can print multiple houses all together at the same time.
Cool.
And the printer just keeps coming back and just keeps on building, and they can have different floor plans, everything, because it's all CNC. So it knows when to stop, when to start, so they can just do the complete several houses.
I know I've seen, I get most of my information from YouTube Reels or Instagram Reels, evidently, but I know I've seen, like, in China where they've had these big apartment complexes that were built with 3D printers, and they're, like, humming along, and like you mentioned, it's kind of like on a little, like, rail car system or whatever that just goes around and cranks them out, but...
This one,
Darson
Say
F.
like to me-
Episode 643, Big Pockets, guy.
All right, that's what I was going to say.
Talks about 3D printing.
Oh, okay.
Yeah.
Cool.
Oh, sweet.
Municipalities would have to catch up a little bit too, because that's a whole new world of inspecting and stuff.
Right.
they were saying 20 some hours to print a house.
Yeah.
So what's
It's just the exterior walls. What? Is the only thing that turns.
so like let's think big picture of like what does that solve, right? That solves the lack of inventory. So watching that get cheaper and more usable inventory is going to go up faster, right? Like that's the big economics, labor, right? So that's the problem that's solving, if you think about it in economic side. Yeah, Junior.
I'll take on that. Your experience with wholesalers or your experience with Burr?
So the question is, just to reiterate from Junior, is what do you guys think about wholesaling? Maybe define it in your terms, because I think there's maybe a few definitions. And then Burr, which is by rehab, refinance, rent, refinance, repeat. Yeah, get on social media if you haven't heard any of those terms. Junior's right. So yeah, what do you guys think? I mean, go online, whoever has comments.
At least I'll speak a lot to the Burr method because that's basically how I started out. So, I mean, to me that was a fantastic way to start out. I was lucky enough to be in the position where I was able to bankroll the purchase and the rehab on my own, and then refinance afterwards. So I was able to kind of save up that nest egg first. But then it was just a good banking relationship. So that was a hard thing to get started. I would say too is. It's hard for people to take you seriously when it's your first one or two or three. So building that good banking relationship where I just basically knew I was going to be approved for the next one and didn't have to go through a whole vetting process to move on. But I did that. That's how I started. Yeah.
I have a buddy of mine in Omaha that whenever he goes to a meetup, and we have a couple there that are usually about 100-ish people, 100 to 120. And he wears a T-shirt that says "I love wholesalers," and like that's what he wants to do is meet wholesalers so that he can like source deals from them because he's lazy. But they work hard. Well, I'll say this: this could take a bit, so I'll try and sum this up. Nebraska just outlawed wholesaling. They introduced legislation called LB 892, which basically they put a lot of thought into this because a lot of wholesalers that I know really were trying to figure out the end around. Like, okay, well, yeah, they said that, but how do we do this? And there's got to be a way we could double close. And they outlawed double closing. You cannot market a property that you have equitable interest in unless you have a license. Period. And they're going after them. Like this was just introduced in July. This last month. So everybody's still kind of trying to like hold their collective breath and figure out where exactly that leaves them. But Iowa's still fair game. So like Council Bluffs, everybody's like, oh, Council Bluffs. And me and Brandon are like, we've been buying here for years. Where have you guys been? So now like Iowa's now the hot thing there. But I would say it's the way a lot of people get started because it doesn't take a lot of capital, right? So Junior, like you've probably, I'm sure, bought houses off of wholesalers. We have. I like the good ones. I don't like the bad ones that are lazy and they just try and...
Yeah, expand on that. Good and bad.
Okay, so bad, meaning good wholesalers get a property under contract. They have full disclosure with the person that they're buying the house from or get it under contract. And my definition of wholesaling is you get a property under contract, you assign that contract to another buyer, the end buyer, you close on it, the wholesaler makes an assignment fee, and you bring the money as the C, the end buyer. So it's A to B, B to C. It's the C that brings the money, not the wholesaler. Or you could get a property under contract and do a double closing. I'm sure a lot of you are familiar with that. Basically, you buy it and sell it on the same day. So that's the way that a lot of people get around it, so that the seller of the property, the original seller, doesn't know how much you're actually raking out of it for a wholesale fee.
They might not even know you're reselling.
They may not know, but I think the right way to do it is full disclosure and say, hey, this may or may not work for you, but I have a network of investors that I'm a part of, and I will buy this property for X. If I can't find somebody to buy it for that number, I will buy it myself. That's the right way to do it. I think the wrong way to do it is to what we call daisy chain, a wholesale property. I don't know if you guys get this in Des Moines. We do periodically in Omaha. You'll get somebody that's like, hey, can you help me dispo this property? They'll get a property under contract, and I'll be like, hey, Dave, you want to schlep this around to your investor friends that I don't know and see if you can get a price. So then you tack on an additional assignment fee because, I mean, you need to make some money on it too, right? And then so you get the same property. I get the same property, and Brandon and I do this all the time. We'll get it from like 3 different people with 3 different prices on it. We're like, what the hell is that? Who actually has this under contract? We're like, oh yeah, that's my partner. We're like, no, it's not. That's somebody that's helping you dispo it. Anyway, that's my rant over. But like, there's good and bad wholesalers. So if somebody's doing it right, there's full disclosure for everybody, and the seller of the property knows exactly what is going on, and you can do a showing, and it's not a big deal. You know, like bad wholesalers are like, well, I have to show it today from 8:47 to 8:48, and you can't say anything. You're my contractor. It's like, really? I'm not I'm not an actor. So that's
Good.
Yeah, I've had good experience on the most part with wholesalers. I have run into a couple times though where even though everything was disclosed up front, the closing real estate lawyers didn't want to touch the deal because there was a wholesaler involved, and so they would either just flat deny it or say we had to structure the deal differently. So there is some of that resistance that goes on. The Burr method is awesome because by the time if you buy it right with cash flow, and then by the time you're allowed to refinance it, which could be anywhere from 2 to 5 years depending on your lender and the loan you have, generally I try to structure deals where when I refinance I get all of my capital back out, including the rehab. So then I'm into the property for nothing and it still cash flows. And you just keep doing it. You keep adding on.
Good. There was a follow-up question.
I was going to ask you, so I've done a wholesale where I was the purchaser on kind of like your A. I was,
The C.
person C. Is there, in the state of Iowa, is there a legal, would I ever run into legal problems down the road in the fact that I brought the money and the wholesaler didn't bring the money? Is there a problem in the chain of title in the state of Iowa, or is that like perfectly legal?
No.
Any attorneys here? But
Well, once it closes,
Right.
it's not going to go back.
I mean, now if the original seller thought they were taken advantage of, I mean, there could be something there. I've never heard of it, but it wouldn't be like
never
chain
run
of
into
title
that.
issue. Though.
yeah, because you'd be clear in the title.
Yeah.
they may try and unwind the deal, but I would say as the C component of this transaction, or the end buyer, I would say your liability is nil on that. Not an attorney. Hashtag.
Okay, question over there.
Would you recommend REITs during uncertainty, like this period of uncertainty?
Question was, would you recommend REITs in this uncertain times?
I don't know enough about REITs to give a good answer on that. I think it's basically kind of hitting the easy button if you want to be involved but not participate in real estate. Is that fair to say?
Yeah.
Like, you don't want the risk of outlaying that much cash when there's so much uncertainty in the market, but you also like the asset class of real estate. Then I think REITs, and maybe there's some stocks out there also that that allow you to get into it. There's there's syndications. There's you can get on what's like Roofstock, CrowdStreet. There's a lot of crowdfunding platforms where you can get in for like $1,000. I mean, that's a good way to participate in real estate without actually having to be out there in it every day.
Right.
So
At least in those smaller ones too, you get a chance to maybe see some financials and things like that to give you an opportunity to learn. A REIT, you're just not going to learn much. I mean, it's just like buying a stock, so you're not going to see the details. But like a syndication, at least depending on the syndicate, the GP, but you'll see the financials each quarter or whatever, see how it's doing, see the occupancy, the improvements they've made. So at least it gives you a chance to learn.
You're buying the asset class,
Yeah.
right? Without owning a property,
REIT. Yeah.
right? In a REIT.
Yeah, so the question is, when you're underwriting deals in a rising interest rate environment like the one we're in, it's a pretty significant rise over the last, several months. How do you approach underwriting differently? More carefully, I would say that. So you're not going to get bailed out by just runaway, offer on everything now. But I would say rents are also bailing people out because rents are skyrocketing also. I don't know how they are in Des Moines, but I know in Omaha, I mean, they're keeping pace with prices of housing. So I think you can get much better rents than you could, even a year ago, even, 2 years ago especially. I mean, they're significantly different. So I think that helps. And I think if you just focus on making offers, And you underwrite the deal, and you do it with the interest rate where you know you can lock it in, right? So if you have a rental property that you know you're going to take it down, it's not going to be a flip. You're going to do a buy and hold. You operate under the knowledge that you have of the current interest rate that you're able to obtain, and then you do your analysis of, is it going to cash flow? You have to rerun that stuff all the time. Figure out what the current rental rate is for that. If you're working with a property manager, they should have their thumb on that data for you. You can say, what's going on? Is anything changing? Look in this area or this street or this part of town, and they should be able to help you with that. But I would say you underwrite on the low side of the comparables in the neighborhood, whether it's rents or pricing or whatever it is, as opposed to doing it, maybe you could get away with doing it in the middle before, right? Especially if you're doing a flip or something like that, where, we've had it pretty freaking good the last, 5 years. So that'd be what I would say.
You nailed it. The only thing, with the rents going up a lot over the last year or two, so I just bought a portfolio of single-family houses, and they were all, I would say, fairly. I think 13% is what we're up from December to now. So fairly significantly under. So don't just take what it's currently rented as the gospel on what it could be for the neighborhood. Obviously you don't want to just jack somebody's rent up, so that's not the case. But at least a turnover, or you can grow that some.
So come back next month. We'll have Brad Neal with the Renters Warehouse to give us some stats. Right. So Junior just mentioned when you are using an agent or you're writing a purchase agreement yourself, there are pieces of the purchase agreement that you can put in there. So if you have a property under contract or you're submitting an offer and you can't close at a certain percentage, then the deal can be voidable by you as the buyer, and the seller can't keep your earnest deposit legally. So definitely talk with your agent or whoever's writing your contracts to make sure that you have. That's just one of many. If you're using a good agent, you should almost always be able to get out of a contract. Quite frankly, that's my goal when I write offers for my buyers, is being able to get out of some capacity in some way if something uncertain happens. Question was identifying a property manager to use on your rentals when maybe you're transitioning from owner management to property manager.
So I don't want to be the negative one to start, but I'll give you my background so far. So when I hit 6 single-family houses, so I was running another business with like 20 employees, so time was my issue. So basically, when I got to the point where I was waiting for it to go vacant, then over a few weeks I'd go in and clean it up, and then I'd advertise it. So it was like 30 days before I'd even have the thing up advertised. That was my big red flag that it was time to get some help. Property manager can get it on, advertised before the tenant even leaves, and a lot of times you can line up a tenant ahead of time. So I hired one at 6. At around 70, I ended up catching this, and it's nobody that anyone here probably knows anymore, but I caught somebody skimming some money. So that was about 4 years ago now. So at that point in time, I brought everything in-house. So I actually have W-2 property managers and maintenance to kind of alleviate that issue.
Hey, how did you catch them?
So it was a really simple little thing. So I had a guy that would charge me $35 every time he would go clean the grounds at an apartment complex. So that was $105 a week. He'd do it 3 times a week. So I was going through the numbers. I got to the point after like 2-3 years of working with this person, I was just looking at reports and not invoices, So it was 105, 125. I thought, okay, well, you can't divide 125 by 3, and he's not going to charge me some $43 That was odd. So then I kept watching, and then all of a sudden it was like 130, I don't know, some other number that wasn't divisible by 3. So I knew the contractor, so I shot him a text and said, hey, what do you charge me to clean up lots? Chase, just like I always have, $35 every time. And I said, well, some numbers aren't adding up here. And he said, well, you're the only person I do QuickBooks for, so here's my username and password, go ahead and log in. So I logged in and compared all 200 of his invoices to theirs, and come to find out what they were doing is they'd get an invoice for $200, and then the gal that ran the company would put plus $30, and it'd be $230. And it was never enough that I would, wouldn't be a major red flag, but it was a couple $1,000 a month by the time I caught it.
So it was the property manager, not the cleanup guy?
No, it was the property manager. Yeah. And then when I called him out on it, I had a spreadsheet. I waited about a week, took a breath, and then had the number that I thought that they owed me. I knew there was probably more, but that I had proof of. They wrote me a check within a week, and we brought it all in-house. So, they knew it was wrong. But so, any positive experiences?
Tough to top embezzling off the top of it. So the original question, I think, part of it was, when do you hit a point where you need to bring third-party property management into play? And for me, I had a W-2 job, and I had 2 young kids at home, obviously wife, and I hit probably 20 single families before I started to really notice my lack of just ability to do a good job at anything. Like I was just struggling with, life and kids and job, and like it felt like I wasn't doing good at anything, and something had to give. And I had a buddy of mine that was part owner of a property management company in Omaha, and he had been chirping at me like Jiminy Cricket for like years, like, when are you going to give me one of those we can manage it for you, blah, blah. I'm like, I got this. I'm building up my cash flow. I'm smart. And then it took me like a month to even get to like a unit turn, right? And it took forever. It was just taking forever for me to do anything. It was like stealing in slow motion, And I'm like, all right, fine, do it. And so he had it rented like a week later for like $120 more than I would have charged. And I'm just like, oh, I'm such an idiot. I could have done this a long time ago. My answer to that is I think you hit about 15. I think you can manage yourself and do probably a pretty decent job at it until you hit about 15, give or take, depending on your family situation and job and so forth. But you start slipping after that. So I think you can handle it until then. 10 is probably the better number, but I think 15 is probably the tipping point where you start really struggling.
And I'd say know your own personality too. I'm a nice guy, and sometimes it's hard to deal with tenants as being the nice guy. So I love the maintenance, actually, love the construction side. Dealing with tenants, I'm just too nice. So
100%.
I have the right help that's better at that than I am.
Yeah. I had a different experience. I got up to about 90 and decided maybe I need some help. But during that time, what I learned was, when I acquired a new property, I got it to the point where I automated as much as I could. And then once I got good tenants in there, the checks just came every month. And I have to say, I've had a lot of good tenants over the years. Some of them have been repeats. I've had one person that's rented from me 3 times now over the last 30 years. And you get that stuff on automatic, and you got a good tenant in there, and they're taking care of the property. You don't have to go inspect it. You don't have to follow up with them on checks, because it just happens every month. And once I got a new property to that point, then I would go get another property and then get it up to that point, and then keep doing that over and over and over. So it was about, I can't remember now. But I ended up partnering with somebody, and we had a management company. And so they were managing all the single family homes in Des Moines. We had quite a few at that time. And then also when I had apartments out of town, ended up getting a manager there. And then 4 years ago, I decided just go ahead, bite the bullet, and get a manager for everything else. And that freed up my time quite dramatically. But again, that's part of the lone wolf thing, I think.
So I'm still self-managing. So I manage about 30 right now. And I guess the thing that catches up to me the most is the maintenance side. So we're in the process of looking for somebody that can do maintenance on a regular basis. And because really, the collecting the rents, the finding the tenants, that's really not the hard, for me, that's not the most time consuming part. A lot of this is, rents, a lot of people pay electronically now, so that makes it a lot easier when the payments come in. You can automate a lot of things, so we've done that as well. Although I do know that I'm probably not too far away from having to find somebody to pass it on to, but you can manage quite a few. It depends on how much time you have. It depends on the tenants. It's helped that we've only had single family houses, so the tenants tend to stay longer. They tend to be more established. They tend to take care of the properties. They do all the maintenance. The only time I get called usually is, water heaters, furnaces, air conditioners, things like that. And I'm calling somebody else when those calls come in anyway. So that's been my experience.
Cool. We'll do one more question, and then we'll just open it up and let everyone kind of just network. And
I'll just go ahead and start. I kind of had to be pushed to
repeat the question.
So the question was, when do you know when to stop your full-time?
Get a real estate full-time.
Yeah. Stop your W-2 job and go into real estate full-time. So for me, it was a side hustle for me for about 16 years. So I kept my W-2 for a lot of years, and then it was 2020 when I went full time. So I had to be pushed out a little bit. Although I would say that I did get tired of the W-2 job at the end. For me, it was fortunate because it was something I enjoyed doing for a lot of years. So that kind of kept me in that. The amazing part, though, is that once I did go full time, opportunities are just flying in from all over. Honestly, it's just we've grown more in a year and a half than we did in the first 18 years. And that's because I went full time.
So for me, my only kind of real job, I would say, was between 09 and 12. So right after 08 when everything kind of went a little crazy. And 12, I think my son was 9 months old. So I remember thinking, so I didn't leave to directly go into rentals, but I had that other business I was running, so it was still kind of the self-employed path. And I remember I was making barely enough to survive on my kind of side hustle, and my son was 9 months old. So I remember thinking that, when he's 5, 10, 15, it's going to be even harder to pull the trigger to leave. So you can always find another job. You see unemployment right now, right? So you can always find another job. So if you don't have a lot of responsibilities, I would say, then make sure you just have enough to survive and go for it.
I love that answer.
Like Dave, I was a corporate drone for probably about 20 years, but I started investing in 2005, so it took me, and then I left in 2018, so math, 13 years. I would say I never felt fully comfortable until I had a proof of concept that I could generate a boatload of cash while I was working my full-time job. So I put up a website and started doing pay-per-click and direct mail, and I did that for basically a year before I left my job. 2017, I made like double almost what my full-time job was, and I did okay. Like I was good at what I did, and I probably made like 130 grand plus benefits and all that. So it's tough to leave those, especially after you've been doing them for a while and they give you a little bit more, and then you get a nicer house and you have a kid, and then, like all that, right? Like you keep sprinkling in life stuff and it gets harder and harder. I think the catalyst for me was when I started, and like Bob, I was actually a lone wolf forever. Like I think I had 90 units before I ended up leaving my job, so I was going after it pretty hard with real estate. But I met Brandon in, I think, 2018. We ran into each other. Or no, 2017. We were like competing on the same deal together, and he got pissed because I got it. So he called me, and we struck up a friendship. And he was kind of in the same boat. Like he had worked in the same gig for like 14 years, was burned out. I was burned out, couldn't find a path to get there, and we just figured out. And I can't remember. I think Bob, it was you were mentioning like you want to find a partner that you align with on values and your true north and kind of the things that are important to you. And we found that pretty quickly. But then we started to have to figure out how do we make a business out of this. And then I think we both just had the guts finally, like misery loves company, so we decided to like pull the cord and jump out. But I had a good sense of like, okay, this is possible because I loaded up my pipeline and just embraced the suck for a year, and was able to make, I kind of made it rain that year. I mean, I look back now and that was like a good time to do it, right? Like I'm not smart, I just happened to get lucky at the time I decided. But now it's like, God, I wish I would have done that sooner. But one other thing I want to say, I started surrounding myself and going to meetups and just meeting like ballers and people that were just getting after it, right? And the more I started just kind of like just being around those type of people, then I felt like I could finally breathe and tell them like what is going on in my crazy head with real estate investing. Because I don't know about all you, but I'm sure family and friends that you don't even bring this up to because they think you're a whack job, right? Like you got the bug. I mean, it's kind of like COVID. Right? So they avoid you and whatever, but then when you find your people, like we're all here, you know what I mean? You can go and be like, hey, what's up? How many rentals do you have? They're like, oh, 18, sweet. And then you just go into a half-hour conversation. That's weird, but like here we are. So I think find your people, get a proof of concept under your belt, experience some success before you pull the ripcord and jump out of the plane, or I guess you want to do that second. But that'd be how I would suggest it.
Yeah, for me, my experience was I was pretty much wanting to double my net income over my job income. That was my goal before I left. And but I did, like others here, I did like what I did, and I actually didn't give it up till last year. So I've been full time just a little over a year, about 13 months. So, but for you part timers, I have had up to 165 units. So you can do it part time.
And manage them all.
And manage most of them.
Well,
yeah.
Cool.
So
It's kind of like dog years, though. You do go a little crazy after a while.
Yeah, yeah. And the luck thing is, just prepare yourself, get yourself in a good position, because when the good things happen, then that's when you feel like, hey, I got lucky, or I was smart, right, or both.
The harder you work, the luckier you get.
But yeah, get yourself in a position so that when things change, you're prepared. I mean, in 2007, I owned 0 single-family houses, and then by the time 2014 hit, I think I was up to, with partners, I think it was up to like 50 some. After a while, you lose count. I don't know if you guys experienced that. Your friends can't understand. How can you not know how many houses you own, right? You ever get that?
Yeah. Cool. Okay. Anything else, fellas? Well, I appreciate you guys. So, right now we'll just end it. Everyone fill in as you wish, and again, next month if you sign up back, I'll send an email out so you know where it's at. It's probably not going to be here. Sorry, Nix. But good problem to have, and we'll have Brad Neal on to talk about rental properties and where those rates are going and all that process. So, thanks. Appreciate it, everyone. Thank you, guys. I appreciate it. Thank you very much. I really appreciate it. Yeah. Yes, absolutely. Thank you.
Good job.
Good turnout. I just think, no kidding. They're just hungry for it, right?